Hello everyone, I'm Ted Oakley and back here with Oxbow again for another interim video for you. I didn't expect to be back this soon, but we've had so much volatility that I really wanted to try to go over a few things that we're seeing in the marketplace and give you some ideas of what we think probably will happen over the next few months anyway. There's some good, there's some bad, there's some things going on. Secondly, I want to mention to you that Oxbow is fully functional. Most of our people are not working in the office, but we don't have to be doing that. So just in case you need anything, phone lines are open, emails are open, everything's functional. Let us hear from you if you need something. Now, having said that, let me just mention something that's going on right now that we've noticed. The one thing that happened in this past month happened to do with people getting caught off guard. And we had mentioned for the last 2 years that this market was really fully priced in terms of valuations. But then along came a couple of other things, like we mentioned before, which were oil, the trade, and then the virus. And that really accentuated the high valuation we already have. But here's the primary thing. One of the things you'll see here is here from basically H.P. Lovecraft, that will tell you that fear of the unknown is what will make you really go crazy. And I think that's what happens in these periods of time. People fear the unknown. They're okay sometimes if they know what's happening, but there were so many unknowns and still so many unknowns right now that it's really caused a lot of things to go on in the marketplace. So let's look at the economy. One of the things that came out today were some numbers that I'll get to in just a second, but the one thing we notice right now is that world trade is negative. And if you'll notice the times when world trade goes down and goes negative, it stays there for a while, number one, and secondly, it virtually every time creates a recession of some sort. Secondly, if you'll notice, these are the purchasing managers indexes of various countries. You'll see here different U.S., Eurozone, the United Kingdom, Japan. They're all the same. They're falling off the map. What that means is nobody's buying anything in the marketplace in terms of wholesale. This on a business level. This is something we watch, and when it goes to a certain level, particularly below, say 48 to 50%, you know you're getting in a deeper segment right there. So today, just announced this morning, we got the initial jobless claims number, okay? Now we did not get the unemployment number. We won't get that until next Friday. But this was the largest ever. It was off the charts. Over 3 million people applied. And so what you're seeing is a tremendous push of people that all of a sudden don't have a job. And the problem about that is we still don't even have the bill out of Congress yet. That gives you a situation where people are going to run out of money. That's our big concern in here, especially for the person that works by the hour, that's just going Friday to Friday. And there's so many people like that in the country today that don't really have the money. And that the fact that we're sitting here almost Friday tomorrow and we don't have the money in the system and ready to go. And my guess is the way they bumbled things that we wouldn't get it until maybe a week later. I wish it could be done better than this, but the problem with that is that 70% of the people in the country don't really have any money. If you'll notice in this slide is that when unemployment turns up, when people are unemployed, it goes straight up. It doesn't flatline and go up a little bit at a time. It explodes on the upside, and that's what happens in recessions. That's where we are right now. You're going to see that line explode again. And when it goes up, and just look at what's going on here. Just notice how parabolic those things go. They get there very, very rapidly, and there's not much anybody can do about it. I think that's what you're going to see when that gets announced, the actual unemployment number. That also leads me to this slide, which has to do with by age, savings and by household income savings, okay? What I need you to see on this is a slide that shows you people that have no emergency savings, okay? Zero, okay? Notice the people in the age groups, particularly, honestly, from really 60 on down on the left-hand side, and where they have no savings. I'm talking about 55, 60% of the people in the country. And then if you'll notice the people in the particular income groups that have no savings, and that's on the right-hand column, and you'll see from people making $75,000 as a family and less have very little. And the lower you go, the worse it gets. My point is that, not to be so negative about it, it's just that this money should be getting there faster than it is if we're really going to solve this problem. Here's the problem with our markets today. It's not so much the magnitude of the drop of the stock markets and what's happened in the credit markets, it's the duration. The duration is what gets you. You can sit here and say it's only been a month since the market started down. That's true. But think about the duration of a period if you don't have any money coming in. Also, one of the things I talked about on the economic side, and this is one of those graphs that I feel for, because I really didn't think oil would come on down below 20. It came down last week just barely below 20. But for us right now, it looks as though that number is going to come on down, possibly, $12 to $15 a barrel. I say that because from a demand standpoint and from a supply standpoint, they are just not matched up right now. And let's face it, it's a supply-demand market. You could have something change with that. I don't know what would change it other than a halt on production. But right now, that's what we think we're going to see here. Let's go to the bond market. Let me tell you what's happened in the bond market, okay? You've had all these people in the business in the last 11 years, and particularly what Wall Street has produced are these tremendous amounts of exchange-traded funds. Okay, now what they do is they go out and buy a bunch of bonds, and sometimes they don't buy that many. And then you have all these people that don't really understand the bond market, but they're in our business. And so they just click a button and buy an exchange-traded fund. Oh, that's great. That's a bond fund. We'll buy that corporate bond fund, and they'll buy this municipal bond fund because you don't pay taxes on that. And so they do a line item investment, okay? We knew this would happen. When things get bad and all of these novice people in the business just hit the button to sell because they can't control the psychology of their clients, all of a sudden you've got a tremendous amount of bonds for sale and nobody to buy them. The bond market's a very, very slow moving market. It's not like the stock market. The liquidity is much less. And so all of a sudden you had that happen, and then you get this tremendous amount, if you'll notice in this slide, where this bond exchange trading volume just exploded. It went up 7 or 8 times. The next thing you'll find, and I'll use this as an example, this is one of the iShares investment grade corporate bonds, meaning everything above BBB. And if you'll notice, it went from 134 to 108. This is a corporate bond, pretty good bonds in many cases, exchange traded fund. But when you take and hit a button and sell all the bonds at one time, and your dealer network's not really set up to do that, then you're in trouble. One of the things that's really affected our market in the bonds, and I want to say this to you, is if you look at what happened after 2008, if you look at all the restrictions that were put on the dealers and the banks, they told banks you can't become dealers and basically hold a lot of inventory overnight. They didn't want them to take the risk of having inventory. And then you had Dodd-Frank, you had Basel III, you had the OCC. All of a sudden, you've got situations to where our dealer network is really, really small right now. And they can't take on as many bonds. And so when this happens, they have to just go, what we say, go to the street with them. In other words, sell them to anybody that would buy them. So they go to these ridiculous levels, which I'll show you in just a minute. And that's what happens here. So if you see your bonds down, You'll know why, because they may be great bonds, okay? They may be 2 or 3 or 4 or 5 year bonds, but if you get too much selling into them, that poses a problem. Next thing you'll notice, this was Monday morning. This particular graph was Monday morning, okay? I'm going to show you it's a little bit different today. We're on Thursday, but on Monday morning, if you bought a pre-refunded municipal bond, I'm talking about that was pre-refunded into U.S. Treasuries. In other words, they'd call the bond and they had sold another bond. Those pre-refunded bonds were selling at about 15 or 20 times the yield of the Treasury. And why was that? It's because everybody wanted liquidity, and so they sold this stuff at the same time. It's much better today. In fact, I'll show you sort of where that number is. What you'll see there now is that now we've had the market come back. It's still better though. You know, a great municipal bond, even that's set up, that's already called it in the Treasury market, is still about a 130 or 140 relative to nothing for the Treasury. But people don't use their heads on these things. The last thing I would say is the stock market. And this is probably where most of the people that are around this are probably missing some of the points that go on here. A couple of things come to mind. Number one, as I mentioned on the opening slide, if you've had an 11-year bull market and nobody has any liquidity and is not ready for it, then they can't help, it drives them nuts and they just have to sell. They cannot stand it. We have 11 years worth of people that absolutely have been advised by people that also do not know what they're doing. And so it was sell, sell, sell. And they made probably some big errors and some things, but where we are today is different than where we have been in the past. If you'll notice this slide, look at all the other bear markets that have been here before. They were bad markets, don't get me wrong. But this one came in 1 month. Look at the middle graph on here that shows the months of a bear market. And if you want to know why this was so dramatic, it packed everything into a 30-day period and people couldn't take it. It was too big a shock to the system. And they had also had 11 years of complacency. Hey, the Fed will come in, buy the dip, it'll come back, we'll go back to new highs. Didn't work out that way, by the way. And we didn't think it would in the last year and a half. That was our message to most everybody. But if you'll notice, and this may not be over, by the way, but that was where we were, on the February the 19th. If you'll notice one other thing, and I want to bring something to your attention, and you probably never think about things like this, but in this particular graph, on Monday morning, I ran the numbers on the New York Stock Exchange. New York Stock Exchange has 1,900 stocks on it, okay? And a lot of old names, mid-sized companies, a few small companies too, but generally, they're companies that have been around a long time. That's why they're on the New York. They have 1,900 companies. That index on Monday went all the way down to close from where it was January 2016 down about 3%, 3.4% from 4 years ago. However, if you look at the Dow Jones Industrial Average and you look at the S&P 500 and you look at the NASDAQ, they didn't show the damage. And that's because those averages are run by about a few companies that really make the difference. And I'll give you a good example. The Dow Jones up basically 18 to 20% the last 3 days is a sucker rally in our opinion. However, one of the things that's really made that happen is Boeing. When you put something up 65 or 70% in 3 days and it's a major Dow stock, you look at the Dow, it's moved a lot more than the S&P 500. You have to be aware of those things. But what this graph tells us is that probably, on the next dip, when you get it, some of these other averages will actually catch up a little bit. It won't be the same as it's been so far. Right now, if you look at the small stocks, the Russell 3000, they're down 40% from the high. And we don't see that in the larger stocks, but many times they catch up. And so therein is the reason you keep some liquidity. So let me talk a little bit about our portfolios at Oxbow. And I know we'll get different sorts of feelings back on this. But we kept a lot of cash all last year. We had good numbers all the way around. We kept cash this year, but we've done one other thing. We've moved things around to where if we could buy something that was a better company than the one we had, we would sell the one we had and upgrade, but we wouldn't change the cash levels, which is really important. At this stage of the market, when you have this kind of volatility, if I could give you any advice over the last 40 years, it's don't get sucked in to these moves that bring everybody back in 2 or 3 days, and then 4 weeks from now you regret it. That is a problem, and I'll mention that in just a minute in another chart. And I'm going to show you why you don't want to do that. I've been through a lot of big sell-offs, and they all are the same in a way. They hit a low. Sometimes they'll have these really sharp moves back, and then they'll go to lower lows 6 weeks, 7 weeks out. If you looked at October, for example, October, November of 2008, we had no less than 3 moves up that were 10 to 12%, one-day moves. And yet, every time people bought those, they regretted it a month later. But what you'll see with us for here, and people say, well, when are you going to put that cash to work? Well, we're putting it to work selectively, but also particularly in high income, because high income is where we've owned more aggressive income items. And when markets get real tight, where you can see the credit markets tightening up a little bit, you're fine in conservative income because we own nothing but CDs, treasuries, very, very high quality municipal bonds. But when you get into high income, you're into more of an area where we're getting into things that have aggressive income. You have to be more careful in that area, and you'll see us have a little more cash there. Not that we won't put it to work. We will put it to work. But right now, we see this whole thing coming around again. In dividend growth and in our long-term growth, you'll see we've had really good results relative to the market this year. I'm really happy about what we've done, even in the midst of what's going on. But we've really upgraded the portfolios all along. We've done the same thing the others. But here's what cash means to you. I'm just giving you an example of this. If I start out with a portfolio and it's 30% cash and 70% stock, and somebody might say, well, if you don't like the market, well, I say, no, we don't like it because things are too expensive. And let's say the market does go down 35%, which it just did, by the way. Now your 30% cash is actually 40% cash because your stocks are down. So in this period of movement around at the low, you can start to really pick off some things because you have liquidity and the person selling to you does not. The last thing I want to show you, and this comes from me being around a while, just to let you know. In 1987, in my office, they creamed the market on Monday, October 19th. It was already down on Friday. It came back on a Monday, and by the time we finished, it was down easily 32, 34%. A lot of stocks were down 40%. And a lot of people said, hey, this is a low, we got to buy it. Much like happened in the last 3 days. Got to be the low. I've had more bottom pickers and people calling me in the last week and a half to say, hey, I've been waiting on this and I want to buy this, okay? That's typically not what you get at a really good low. Usually at a good low, people are really frustrated. They bought it all along, tried to catch the low, didn't happen. We look at the companies themselves, so if they get really cheap, we'll still buy them. But this was 1987, and I want to show you something here. The day of the crash, October 19th, I listed all of these Dow stocks for you and what they traded for. If you fast forward 5 to 6 weeks and go to December 7th, I want you to look at the difference in the prices. You didn't waste any money. You could have chased it up that first 3 weeks. You really could, the first 2 weeks. And it did move up, but it gave it all back, and you had a chance to still buy those and see if you're going to wash everybody out again. We really, in a lot of ways, feel like that's what's going on right now. You have too many people, too many black boxes, too many people thinking, I got to get this because this is the low. And they've been trained to do that the last 11 years because every time we've dipped, the Fed comes in, gives you a bunch of money. But this time's not the same. I think what you're going to see over the next probably 2 to 4 months, is some agony in the marketplace, but it's going to be different. It wasn't like a one-time shot. Like a 9/11 was a tough market hit, okay? But we knew what it was. You knew what to do. We weren't closed down everywhere. This is a different kind of market. It's affecting everything. It's affecting real estate, and the stock market is not capable, in our opinion right now, of looking over the valley and saying, hey, it's going to be all right in 60 days. I don't think they are. Maybe they are, you know, but there's basically 3 things that can happen. It could be, it could work out to be better than everybody expects. It could be about what people expect, or it could be a lot worse than people expect. I happen to believe it'll probably be one of the, first or second. However, when you're in the money business, you have to go a little different direction. Anyway, so what happens if you look in summary is that the virus blindsided everybody. They weren't really ready for that, and they weren't ready for it in their portfolios either. I really felt like they've all felt all along that we were just going to have another 2 or 3, 4 years. And it's really interesting to me right now, and we've been negative on the market for the last 1.5 years or so, and the people that couldn't get you out at the top or say anything bad about it now are calling for the bottom. So, you can't put those together, just to let you know. Secondly, it will take time for this thing to settle out. I don't know how much time, but it'll take more time than a week. That's for sure. But that's what people are thinking. Hey, I got in, I made a lot of money, and then all of a sudden you retrade it. 35 days ago, February 19th, we hit the all-time high in the stock market. And if you think about that, that is not that long ago. That's 35 or 36 days ago. When you have that happen, you can't have that kind of hit and just say walk away next week and say, hey, the bottom's in, and let's go about our business. We're defensively allocated right now. I'm able to tell you, we've got a lot of liquidity, but we feel like we need to have that, and we think it will do us some good, because when you have adversity out there and people don't want to own things cheap, when you have liquidity, those are the people that make the money. The people with money make the money. You can't do any of that if you're fully invested at this time. And the last thing I would tell you is that really risk management, when you get right down to it, comes down to this one thing, and that is wherever you lay your assets out, whether it's real estate, oil and gas, stocks, bonds, what have you, if you have liquidity or enough liquidity that you can maintain peace of mind because you have that liquidity, you will be a much, much, much better investor by doing it that way. True, part of that liquidity is never going to make a ton of money, but I will tell you that these times come along from time to time, and the people that don't have any liquidity really get caught. So just a piece of advice from us going forward. If you're watching this for the first time, or you want to be on a list, there are certain things that we share with other people rather than just clients. Most of the things are just for clients, but if you'd like that and want to be on that list, certainly at the end of this program, you will see an email address that you can send in and be added to that list. We'd love to have you on. If you have any questions, certainly let us know. Lastly, it's a tough time. I happen to be optimistic. This country's been through a lot of things. If you look at it from 9/11 to World War II to, I came up in the late 60s and early 70s, and I never thought I'd even live to be 25 sometimes because of all the mayhem that was going on. But you look at World War II, where we have a tremendous amount of people who are doing a lot of good. I'm really uplifted, if you want to know, by watching the amount of people that pitch in and help each other, and I think that's going to carry us through. So I think there's going to be some great opportunity too. So with that, I want to sign off. I appreciate you watching in today. If you have any questions, certainly email us or give us a call at oxbowadvisors.com.